If you want to get into the game of building massive wealth for your future by owning multiple investment properties, but you don't have $100,000 to $200,000 of cash laying around to get the ball rolling, then this poor man's or woman's guide to owning multiple investment properties is for you. Most people I talk to assume that the only way to get into owning multiple investment properties is either to have some crazy inheritance or to have a really high-paying job. But this is actually super possible on any budget if you're willing to discipline yourself and make wise choices. It's also worth stating before we get started, if you're one of those that thinks real estate might not be a good way to build wealth for your future, then you should take a close look at what the housing market has done over the last 10 years. Most sources will tell you house prices have doubled in the span of that time. And most assume it will do the same, if not better, in the next 10 years. And this is actually a low average comparatively to some markets in our nation, like our own Raleigh market, which actually saw a 112% gain between 2011 and 2021. For a median priced home, that's $52 a day, $18,980 a year. And that's talking about 10 years ago. If you're thinking about investing in any way, that is a stellar return. But just for sake of argument, let's be modest and say it's increasing at a 50% clip per every 10 years. Hypothetically, if you had bought a home 10 years ago for $150,000, because that used to be a thing, then that same home would be worth $225,000 today. But let's say you started renting that home 8 years ago, and then you bought another home for $180,000. Now this new home is worth $252,000 only 8 years later. That's a total of $147,000 of equity built by the market over the course of 10 years. And if you started that ball 10 years ago, what's to stop you from acquiring even more properties over the course of that same 10 years and on through the next 10 years? I think you can see where I'm heading with this guide, but let's break down the nitty-gritty so you can actually see how to pull this off on your own. Let's go step by step to achieving a potential $1 million of equity over the course of 10 years. Step 1. Buy a rentable property. So many folks are on the sidelines renting right now because it's cheaper than owning. But renting is a zero profit gain. Owning, as I pointed out earlier, is a profit-making machine. So in order to get started, you need to own. Maybe you have to pay a little bit more on a monthly basis, but it's so worth it in the long run. Buy something that doesn't break the bank, but could be supremely rentable when the opportunity arises. Step 2, live in it, update it, and rent it. If you're like most millennials and Gen Zers that I know, you're probably planning to move in the next 2 to 3 years from the place you're currently living anyways. Even families do this typically in the first few years of having kids. I'm simply recommending that you leverage a trend that's completely normal in order to get into investing on the cheap. But even if you want to move sooner than that 2 years and start renting it, that's not impossible. Lenders require you to stay in a home for 1 year prior to renting it out, as otherwise this could be seen as avoiding the lending regulations for investment properties. Investment properties require a minimum of 20% down in order to purchase them because the Fed sees them as a riskier investment for mortgages. That's pretty steep for something you could purchase as a primary residence for only 3 to 5% down. But after that first year is passed, you are free to rent it out as an investment property with no penalty. It's not a bad idea to build some sweat equity into the property first though, before you rent it, so you can increase your rental potential. Update the countertops, swap out some fixtures, change up the flooring, things like that. If you can do these things on the cheap and simultaneously add equity to your home, then it's a great investment for the future. Whenever the time is right, rent this puppy out. Step 3, buy your next property and repeat. You only need 5% down to purchase your next property if it's a primary residence. Not the 20% you've probably heard people telling you you need in order to purchase another home. If you have the 5% in cash, then you can pay it out of pocket. Or if you don't, you can always borrow in the equity from the first home in order to cover the down payment. The real trick here is to make sure whatever you're renting for is covering your costs completely, or maybe even giving you some positive cash flow. If that's the case, even with an equity line, then you're in the green and you could totally pull this off. A beautiful fact is that you don't actually have to qualify for 2 mortgages simultaneously in order to make this work. Lenders look at a valid lease agreement on another property in order to offset your debt. If your monthly payment is $1,500 on your first home and then you can rent it out for $2,000 a month. A lender will take 75% of your rent income, which is $1,500, and offset your debt burden. That means you basically have no debt going into your next purchase with a valid lease. Timing is super important here to make sure this works as you transition from your first home to your second. You'll have to make sure a cost of a new purchase isn't going to put you deeply into the red because of rising home prices or higher interest rates. But remember, if your old property is producing income after you've paid off all your monthly expenses, that's money that can offset your new mortgage costs too. Plus, the goal here is not to go and buy your dream home after buying only one investment property. You should really be looking for another very rentable property to add to your portfolio. It's amazing to think you can build crazy equity by simply living in a place, renting it out, and then buying another. If you ever need to cash out on any of these properties, you absolutely can. If you cash out within 5 years of your original purchase, but you've lived there for at least 2 out of those 5 years, then it will most likely be completely capital gains tax free. However, it's not the end of the world if you have to pay gains if that doesn't apply. You've probably created so much equity by then that it won't be such a massive hit. Or you can do something called a tax-deferred exchange and simply pass the equity from that property into a new property or multiple properties, deferring capital gains to a later time when you liquidate your property assets. Let's take our first example I started with earlier and play this out just to show you the power of this model. Let's not get crazy, but let's say you purchased 3 properties in the past 10 years. One for $150,000, another for $180,000, and the last for $250,000. Then let's say this year you splurged and bought your 4th home for $350,000. Let's also say they're all appreciating at a rate of 50% over the course of 10 years. Now remember, that's way lower than the national average. Let's see how ownership of these 4 properties plays out over the next 10 years. After 20 years of ownership, your first home is up 100% in value. It's now worth $300,000, and that's $150,000 of equity. Your second home is now up 90% over the course of that same time. Now it's worth $342,000 or $162,000 of equity. Your third home is up 75% at the end of 20 years. Now it's worth $437,500 or $187,500 in equity. And your last home, the one you bought this year, is up 50% over the next 10 years. That's a $525,000 value or $175,000 in equity. Congratulations, my not so wealthy friends. You now have a portfolio of properties worth $674,500 in equity. And that's not including the principal that you paid down over the course of that 20 years with someone else's money. On that first $150,000 property alone, you will have paid something close to $70,000 to $80,000 of equity by then. So you're probably pushing somewhere close to $1 million of equity over the course of 20 years of owning just 4 properties. And you accomplished owning all of these properties in just 10 years. You could easily add more and double that in a 20-year time frame. Also, it's extremely possible things will appreciate even more than that 50% we've been using. So you could be sitting on closer to $2 million after 20 years. So to sum it all up, it's absolutely possible to own multiple investment properties with very little money. I'm in the Raleigh market as a local realtor, and I see my past clients utilizing this technique and killing it. If you're in our market and you want to get into this equity building trajectory, give me a shout. I'll be happy to find your first, second, or whatever property that will be a high producing rental. My info is in the description below. Thanks for watching today, guys. If you learned anything from this video, I'd super appreciate if you liked, subscribed, and shared. I'm posting great new educational real estate material regularly to help you navigate the market and make the right choices for your future. Have a great day, friends.